Hi, my name is Ben Shepard and I'm co-editor of Global ETF Profits. Dreyfus Corporation, best known for their family of mutual funds, recently filed the preliminary paperwork with the Securities and Exchange Commission to launch a new line of exchange-traded funds. The filing that Dreyfus made was pretty broad. As far as the asset classes that it was going to be working in, according to the filing, it's got the leeway to use both equities and fixed income securities issued both here in the U.S. and abroad. So they definitely went out of their way not to put too fine of a point on anything. The one thing that was made clear in the filing is that they plan on using active management strategies in those ETFs. And that's a trend that I think we're going to see more of going forward. Already we've got quite a few mutual funds that have entered the ETF game. The ones that come immediately to mind are T. Rowe Price and Vanguard's, really most of the larger houses. And a big reason for that is the fund flows are drawing their attention. In the month of May, for which the latest data is available, long-term mutual funds lost a little bit more than $13 billion in the month in net outflows. That's the fastest pace of losses since the market bottom in March of 2009. Long-term U.S. equity funds in and of themselves lost a net $15 billion in the month. Money market funds lost right around $20 billion in the month. So mutual funds obviously aren't where the assets are going. By contrast, in the month of May, ETFs gained almost $5 billion. On a year-to-date basis, the ETF industry as a whole saw net inflows of almost $25 billion. So if you're an asset manager and you want to make money, you go where the money can be made, and that's most definitely ETFs. The problem is most of these mutual fund houses don't have the expertise or really the incentive to run passive index tracking ETFs. Obviously they already have teams of managers, they already have teams of analysts and researchers, and all these people are already soaking up payroll. So if you can just subtly redirect their efforts into a different asset structure and you're already paying for it, why not leverage that expertise, increase your assets under management, and ultimately increase your fees? But that raises some issues that I've talked about before in the past. Obviously, a big one is the daily disclosure requirement. As it is now, ETFs disclose their portfolio positions on a daily basis, which is fine when you're running a passive indexing strategy. But when you're adding value through active management, that makes it possible for the proprietary trading desks at the investment banks and just other traders to front run. And when they do that, that basically kills any value that the manager is adding. So that's something that's going to be a real sticking point going forward. On the one hand, that's not a big concern when the ETF is small. If you only have a few $100 million in assets under management in a fund, you're not going to be moving the markets when you make your trades. But when your asset bases get up into the billions of dollars and you start moving markets, that's when there's the real opportunity for front running. The other big concern is the current SEC review of the use of derivatives in exchange-traded funds like swaps and futures and any manager of just not a straight long bet on a stock. And those are tools that a lot of mutual funds use to hedge their positions or to hedge out currency exposures, things of that nature. They're tools that funds have a real use for and managers can actually use to add a lot of value for their investors. So these are questions that are going to have to be worked out over the longer term. But in the next few months, though, I really think we're going to see more of these actively managed ETFs hitting the market. And they may be something that investors want to add to their portfolios. The one caveat there, though, is you're going to want to be careful about what you're buying. Just like with a mutual fund, if you don't understand the strategy that a manager is using, and you can't put your finger on how that's going to add value to your portfolio, you don't want to go down that path. But there are a lot of great actively managed ETFs on the market already. One is PIMCO offers their enhanced short maturity portfolio. The ticker on that is MINT. And that's a kind of a money market replacement fund that I've talked about before in the past that's turning in phenomenal results and is more than doubling the current yield that you can get on any money market fund out there today in this current low rate environment. iShares recently launched their Alternative Strategies ETF. It's been around since December of last year. The ticker on that one is ALT. and they use a variety of hedge fund-like strategies, which so far seems to be working out really well for the fund. So there's definitely opportunity there. You're going to want to be careful about what you buy, but keep your eyes peeled because we're going to be seeing a lot more of them. Again, my name is Ben Shepard, and I'm the co-editor of Global ETF Profits.